today we're going to start looking at a specific tax that's very important from an Irish perspective. So it's a specific factor tax because it's a tax on the income of one of the factors of production, and it's a tax on one specific use. So look at the corporation tax, so money invested in companies which earns a profit within that company. So some of the issues raised in the study of the corporation tax are policy objectives, clearly important from an Irish perspective. Are you using the tax to achieve macroeconomic outcomes, investment effects, and financing of firms? What impact does it have on the decisions taken by firms whether to invest in a particular location? Or when it comes to firms raising money, we look at risk bearing, who carries the risk, distributive effects, who actually carries the cost of it, the whole concept of international investment, and then finally looking at some capital flows and harmonisation, particularly from an EU perspective, where much of the move has been towards views that the EU should have tax harmonisation, particularly in the Eurozone should tax harmonisation, but even the EU as a whole. There shouldn't be tax competition within the EU. That if the EU is going to get a fixed amount of investment from abroad, and all countries compete, you essentially end up in a race to the bottom. So with Ireland it being at a 12.5% tax rate, and other countries at similar rates, the argument from an EU-wide perspective is that's not bringing anything extra into the EU, that the investment would come into the EU anyway, but it might influence the location and might actually undermine the total benefit that the EU can get. That if the decision was made sort of on a more economic or a more efficiency basis, it might have a better impact across the entire Eurozone. The argument most would make is that we're over-benefiting by getting additional investment, additional jobs, additional tax revenue, more corporation tax that is in some ways viewed as being too low. But when some studies have been done about corporation tax receipts across the Eurozone, we're actually not below normal at all. We collect about 3% of GDP in corporation tax. So around 4.5 billion would be an average of corporation tax receipts over the last number of years. About 3% of GDP, which would put us at the EU norm. And relative to the size of our economy, and relative to the amount of economic output in GDP, we're collecting an EU norm. So how then with the likes of France, Germany, etc., having corporate tax rates in the 30s, France in the mid-30s, and Germany in the high 30s, how then are they only collecting a similar amount of corporation tax if they have a rate that's 3 times ours? The issue with the different systems in France and Germany in particular is that there is a whole range of allowances and credits that allows the company to reduce its effective tax bill. So while it might be taxed 30%, it's actually taxed 30% of a small amount of its profits. Where in Ireland you'll be taxed 12.5%, and there's very few allowances and credits. So you'll be taxed 12.5% on everything. So the system is a bit more complex than perhaps some of the headline analysis would suggest. And it's not necessarily just down to the rate, it is also down to the tax code and the tax system. But in the first instance, why is there a corporation tax? Why do we tax the profits earned by companies? Companies are just legal entities. When it comes down to it, people pay taxes. So why do we tax companies? These things which just have a legal construction. Why don't we tax the people? If there's a profit to be made from a company, surely that would flow to some individual. Why not wait until the money gets to the individual? Why not tax the income there? Well, there are a number of reasons why we have a corporation tax. One is that it's a benefit tax to ensure that corporations pay for the public goods and services that improve their profits. So although the companies aren't, in a sense, individuals and people, they do benefit from the activities of government. We'll see that it's a withholding tax that serves as a backstop to personal tax, and finally that it captures the rent earned by owners of fixed factors. So why is it a benefit tax? What benefits do companies get that they should perhaps pay for? Well, one would be education. Many people go out to work with companies, have spent 14, 15 years in primary and second level education, maybe 4 years of third level education, And then it's the company will capture a lot of those benefits through increased productivity, increased output, increased profits. So in order to capture the benefits that companies get from education, infrastructure, training, and other forms of public expenditure, they essentially should pay for it. Because one issue here is that if the tax is paid by the owners of the company, if you wait until the money goes out, the owners of the company could be abroad. So if I set up a company in Ireland, earn profits, but the tax system waits until I get the money. If I live in France or I live in Germany, I have my company in Ireland benefiting from Irish public expenditure, but the Irish government gets none of my profits. So the profit is taxed where it is earned in the company. There's also a suggestion that the legal construct of limited liability has a special benefit, should be subject to taxation. This whole concept of companies being distinct legal entities. But the owners have limited liability. But the only money an owner of a limited company can lose is the money they put in. So if you invest a certain amount of money in a company, that company makes huge losses. The owners aren't liable for losses over the amounts they put in. So in Ireland we see the whole issue with the banks. Banks losing perhaps 120, 130 billion. Who is going to be liable for those losses? Well, the first port of call is going to be the shareholders. They own the company. But at the time of the peak, the value the shareholders had in the banks, particularly the covered banks, the Irish banks, was about 25 billion. And that would have been hit first. But as soon as the 25 billion was eroded and wiped out, that was it. You're not going to go to the shareholders and say, look, you're the owner of a company that's after losing 10, 20, 30 billion. You must make good that shortfall. The shareholders have limited liability. While they do feel they've lost everything, if they had to cover the full extent of the losses, they'll lost much more. So there is a suggestion that this sort of benefit, this legal construction of companies as distinct legal entities, should also be subject to a charge. That what you're allowing people of owners of companies to do is benefit from the profits. But if the whole thing goes belly up and there's huge losses, they're limited by how much they can lose. So unlimited on the upside, limited on the downside. So the suggestion is that you tax the profits that are made in the company because of the construction of limited liability. The withholding rule in some areas is related to an issue related to the benefit tax rule. So a comprehensive income tax aims to tax labour earnings. So be that hourly wages, monthly salaries, or other ancillary benefits. It also intends to tax capital income, so dividends on investment, interest on investments, and capital gains on the increase in the value in assets. However, the most difficult source of income to tax is accrued capital gains. If you have an asset that goes up on value, in general you won't be liable to any tax. If you just hold the asset and that asset rises, there is a gain for you, there's an income and a wealth gain for you. But unlike earned income, salaried income, there's no tax receipts for the state. So in principle, individuals report changes in market value of assets and pay tax on the annual increment in the value of those assets, i.e. judge the increase in wealth or the increase in the assets as being a form of income, the ability to command resources. But that's not what takes place at all. When it comes to assets, you're only liable to capital gains tax when the asset changes hands. Either you sell an asset and you're subject to CGT capital gains tax, or you get an asset and you're subject to capital acquisitions tax. But once you have it, if you have shares, if you have an investment, if you have property, up to now there's been no tax on the actual value of the asset. Although for residential property we are moving towards a stage where some form of residential property tax will be introduced. At the moment we just have this so-called household charge, €100 per annum. But that's not necessarily based on the value of the asset. If your asset falls in value, your tax liability doesn't fall. We will see over the next couple of years what's been introduced maybe as a site value tax, or some tax based on the value of the asset, which might capture it. But within companies, the value of companies can increase quite dramatically, be it quoted companies in the stock market or unquoted companies. no corporation tax, an individual would essentially be free to accumulate the value in the company and also to accumulate the profits and not pay any tax. So with the withholding rule, there is clearly a number of problems. First of all, companies have no periodic market value. Market value changes by the instant. As soon as there's any trade and it's at a different price than the previous trade, a company's market value changes. So when do you pick? Do you pick some arbitrary date in the middle of the year? Do you pick the 31st of December? And all of these could be subject to vagaries of a stock market, different effects that affect prices throughout the year. So you could have prices dipping towards the end of the year, perhaps maybe as pension funds firm up in some positions. Maybe they have to make payments to particular clients or make payments on pensions. So you might find a lot of sales taking place. So you could put a value on the 31st of December, but you might see in the couple of weeks before that lots of investment funds have been selling and prices are artificially depressed simply because of the time of year you've picked. And there are other effects throughout the year where prices rise and fall based on not sort of the value of the company, but based on the actions of market participants. Secondly, if you tax assets, the taxation of gains, increases in value, could force people to liquidate assets to cover tax liabilities. So if somebody owns a certain number of shares, they own a company, and that company goes up in value. If they're subject to a tax bill because of the increase in value, it might be that the only way they have of paying the tax on this asset is to sell part or all of the asset, depending on how divisible it is. So in fact, the tax on the value could force the sale of the asset, which isn't necessarily what you want the tax to do. So in general, most regimes, including Ireland, tax capital gains on a realised basis, i.e. when the assets are sold. So if you buy shares at a certain price, you only pay capital gains tax when you sell them. So as a result of taxing only realised gains, investors could shelter their income from taxation by letting tax-free corporations hold their assets. If you owned a company and companies didn't pay tax, you could just leave the money in the company. If that company made a profit, you just take out what you need for income, what you want to spend, but you could leave the rest of it inside in the company. The company could maybe put it into the bank, the company could invest it, the company could hold on to it and accumulate and earn excess returns. So what we'd simply do is allow people to shelter their income. They would be earning this profit, but if you left it until it came out of the company to tax, a lot of the money would be left in the company. So the issue with taxing both earned income from workers and other sources and earned income by corporations is to try to reduce the incentive for people to keep money in companies. So sometimes there are advantages to setting up a corporation, and lots of small business people, sole traders, the self-employed, etc., will do so on a company basis. But to avoid them keeping excess funds in the company, for the privilege of having a company, they would be subject to corporation tax for the profits earned by the company. So if there was no corporation tax, people would only pay tax on dividends received or capital gains arising from the sale of shares. So dividends received when they take money out, or capital gains when they sell it, if there was no corporation tax. So unless they took money out or unless they sold some or all of the company, no tax revenue would be earned. So when it comes to the company, what do you tax? What income within the company is taxed? So there are different suggestions for what's called the corporate tax base. So what do you calculate your tax bill on? What is the base? So YR is just some income of the company. R is revenue. C is costs. So here we have some measure of profits. Revenue minus cost. Then you have an allowance made for depreciation. The reduction in the value of assets a company owns because of use, wear and tear, etc. So we have revenue, cost, depreciation. depreciation. I is interest the company pays on financing. And div is dividends. So what could you tax in a company? Well, you might tax its total revenue, less its cost of sales, less the depreciation amount, less the interest it incurs on borrowings, and less the dividends it pays to shareholders. Because this is the money that's left in the company. This, in a sense, is YR. You might consider this to be retained earnings. What is left or kept in the company. So the total revenue earned, the costs, cost of raw materials, cost of sales, cost of labour, cost of advertising, cost of services, whatever is incurred, depreciation on assets, interest and dividends. So in this instance, you'll be taxing what's left in the company. And that seems to satisfy the conditions of the withholding rule. That you don't want people leaving money in a company and trying to shelter or evade taxation until they take the money out. So why would you allow dividends as a deduction? Well, one reason to allow dividends is that they're taxed at the personal level. That if somebody takes dividends out of a company, that then becomes income for that person. And they then declare that to the revenue and pay income tax on those dividends. So perhaps to avoid double taxation, the company is earning the profits. If it forms part of the corporation tax base, there's tax paid on the profits. If there's dividends then subsequently paid out, and that those dividends are taxed again, well, that's doubly taxing the same income. The company has generated this profit, you tax it within the company with the corporation tax, and once the dividends are paid, you tax it again with the income tax. So one reason to suggest that the corporate tax base should be net of dividends is that dividends are already taxed at the personal level. However, in the greater majority of cases, dividends aren't allowed as a deduction. So a company pays its corporation tax and then pays a dividend to shareholders. So it actually pays the tax on the profits in the company. So governments rarely allow a dividend deduction from the corporate tax base, though distributed profits may be taxed at different rates. In Ireland they're all the same, 12.5%. In other countries they can be at different rates. So you pay a tax on how much you keep in the company, and you pay a tax on how much you distribute. So in general, the corporate tax base is the following. So how much income of a company is taxed? Well, revenue minus cost minus depreciation minus interest on borrowings. Interest and dividends are relatively similar. They're paying for the use of money. But with interest, the person you owe interest to has no ownership right. If it's a bank that's lent you money, if it's a bondholder that's given you money and you've issued a bond, you pay them interest. But they don't have ownership and don't have rights to the profits. The interest payment will largely be fixed. Whether it's a loan from a bank or a bond, it will generally come at a fixed or close to fixed interest rate. With dividends, it's paid to shareholders. They've given the money initially to set up the company and perhaps been asked for some subsequent money in the meantime, or somebody has bought the rights that the initial owner set up. So dividends come with, because of an ownership right. And the issue with dividends, of course, is that there literally is no ceiling on the upside. That as long as the company keeps earning profits, dividends can continue to increase. So one issue this has is on the financing of companies, whether something is tax deductible or not. So why don't governments allow a tax deduction of dividends? Why do dividends form part of the corporate tax base? So the justification of this is that deduction of dividends would result in erosion the amount collected from foreign direct investment. If all the multinationals set up in Ireland were allowed to make a dividend deduction before they paid their corporation tax to the revenue, they'd simply say we're paying 20, 30, 40, 60, 80, 90% of their profits in dividends, either back to their parent company or out directly to their shareholders. And they tell the revenue commissioners, look, we earned 5 billion of profit in Ireland last year, fair enough, but we gave 4.5 billion out in dividends. That money will be taxed when somebody earns that income. The issue with the multinational sector, of course, is that they'll be somewhere else. So unless the government taxes the dividends within the company, collect the revenue. So here the concern is a desire to withhold income accruing to foreigners from using services and goods within the Irish economy. So thus, under the withholding rule, the corporation pays a tax on income on behalf of its shareholders. So the corporation withholds the tax. So there's a whole dividend payment to be made. There will be a tax due on that. What the corporation do is withhold the tax amount from the shareholders and then hands that over to the revenue. Rather than giving the full amount to the shareholders and saying to them, look, you declare your income, you pay the tax to whoever you owe it to. The issue here was with the non-resident status of many investors and many companies in Ireland. We wouldn't collect much, if any, corporate tax on the profits that they earn. However, to avoid double taxation of dividends and capital gains income, some adjustment is necessary to the personal income tax. So what happens here? These companies have paid a corporation tax in Ireland or in some other different country. The profits then are repatriated to other countries. If it's a shareholder in Ireland, if you own a company in Ireland and you pay corporation tax and you take the money out, you could end up paying money to the revenue commissioners twice. Your company earns a profit, you pay a tax. You take money out of the company, you pay income tax. So the money is being hit twice by taxation. So in order to avoid double taxation, what can be done? There could be a refund of the corporation tax when the corporation distributes income. The issue here is that it would only be refunded to residents within the country. So if the corporation is distributing dividends, the revenue commissioners could then give Irish people back their part of the corporation tax. Say, look, you had a particular share in this company paid X amount of tax, here's your share of it back. Then go to the revenue and say, well, what's your income? You'd have a particular income flow from the dividends, and you have a particular income flow then from the returned corporation tax. You would declare all that to the revenue and then pay your income tax bill. But in a sense, you'd only be paying once because you get a refund of the initial corporation tax. You could then just have a refund to all shareholders, which again might not necessarily be appropriate based on residency, or an exemption of dividends and capital gains and corporate shares from personal taxes. And in lots of cases, this is what occurs, that you declare your full income to the revenue, but you show what income was earned from dividends. And that then may not be liable to income tax. There are plenty of instances where it may be liable for income tax, but you will generally get a deduction, particularly because of differences in income tax rates. If the income tax is 41% at the top rate and corporation tax is 12.5%, well, clearly that would be an incentive for everybody to set up a company. And lots of people who consider to be employees do set up companies for benefits like that. Like most of whom we consider to be employees of RTE aren't employees of RTE at all. So most of the main presenters are actually contractors who have set up their own companies, and it's their companies who deal with RTE. So most of the main presenters would have large salaries, but to say Pat Kenny is on 800,000 a year is perhaps true, but not technically correct. Some company for which Pat Kenny is a service gets 800,000 a year from RTE, and that money goes into the company. So then the issue is what happens to the taxation. That company would be taxed at 12.5%. When Pat Kenny takes money out of PK Limited, or whatever it might be called, how much tax is he subject to there? It will be lower. It'll be reduced, first of all, because his company pays tax, and he'll get a deduction there. And perhaps he can reduce his overall tax bill. I assume this is why they're doing it, because there are tax implications and tax advantages to being set up in that manner. So when you might consider employees in lots of instances, they can be companies. So you do get vagaries within the tax system because of the whole concept of avoiding double taxation. What is allowable, what is deductible, what can be charged. So in many instances there'll be an exemption of dividends. In the US it's somewhat different. If a US resident tries to claim to the inland revenue in America, I've dividends earned there, they were earned in Ireland. Pfizer up to December were selling huge amounts of Lipitor, earning huge amounts of profit. I paid my corporate tax in America. They'll say yes, that's fair and good and well and good, but you owe income tax in America. They paid their corporate tax in Ireland. In the US they would still have to pay income tax tax in America. In the US, if you're a US citizen, you pay federal income taxes on your worldwide income. And it doesn't matter where you live. If you carry a US passport, you pay federal income taxes on your worldwide income. In Ireland, if you carry a passport, there's no tax implications. It only matters, the issue is if you're a tax resident. Are you in the country for more than 183 days? So there have been suggestions that we should tax for Irish citizenship. That there are many people throughout the world, and there are stories and occasions of sales of Irish passports, particularly through some of the embassies, to try and raise funds. But one issue is that if somebody holds Irish citizenship, then perhaps you shouldn't allow some issues such as this to take place, and you should tax them on their worldwide income. So you have non-resident status. Well, that is maybe a separate argument to the corporate tax. The final rationale for the existence of corporation tax is the rent tax. In economics, rent is some sort of excess return, a supernormal profit. So under the rent tax rationale, it suggests that the corporation tax is an efficient method of taxing the rents earned from non-reproducible factors of production. So be that entrepreneurship into setting up the company in the first place, land that the company might own, or natural resources that the company has access to. So if there's no corporation tax, these in a sense are fixed in quantity. You can look to change them, but particularly with land and natural resources, they largely are fixed in quantity. So rent is simply the return to factors over and above that needed to compensate them for their use. So if somebody is engaging in entrepreneurship or using land or using natural resources, there's a certain amount of profit they need to get to encourage them to do that activity. So everybody wants to get a return from doing something. But it's likely that in many instances the return is actually far in excess of the bare minimum somebody needs to do to undertake the action. That person is getting an excess or supernormal return. What we'd consider the economic rent. So taxing rents is efficient since investment and finance decisions are not distorted. Why aren't they distorted? Well, the rent is an excess. If somebody got the normal rate of return, they would still do it. What in some instances they're getting is an excess or supernormal return above what would be required for them to undertake the decision. So what happens with taxing rents is that you have additional to the tax deduction. So OC is largely the opportunity cost. I'm not quite sure what the E stands for, but it is essentially the opportunity cost. What's the value of the next best alternative? If the opportunity cost drops below it, so if you have land and you're using it for agriculture, or you're using it for grazing, or you're using it for development, or you're using it for building houses, if the return is there, and even if there's a tax, you're liable still to continue that activity. It's only when the return drops below a particular level that the activity could stop. So in Ireland, there's been suggestions that on land, there should be development levies, particularly at the height of the boom, when land was selling for huge values. That even if there was these levies, the land would have been sold anyway. But as it was, the tax on development land was very, very low, and some huge returns were earned. So land prices were soaring throughout the last decade, rose by a multiple of perhaps 300-400% over a period of 6, 7, 8 years. And a lot of the activity was pure speculation. People buying a field 1 year, holding it for 12 months, selling it the following year, not really using it for economic activity. The reason for this speculation and purchasing was the excess returns that could be earned. So the argument is perhaps that some of this could have been reduced if there was a rent tax, a so-called development levy or development tax. Because one issue with a low tax on development land is that if land prices are rising, in a strange way it actually discourages investment. It discourages the development. What you want to do is wait until the land prices have perhaps reached a peak and then try to sell at that level there, rather than using the land, using the fixed factor and earning for what should be what's produced from the land, be it shelter, houses, whatever could be produced. So the fact that there was such a low tax in development land, and most of it was held in companies, encouraged hoarding. Why go off and go to the bother of building houses and perhaps have to pay tax on that, when you could wait, see the price rise 100, 200, 300% and pay very little tax. So there is a suggestion that there should be a rent tax rationale. This would then be a specific form of corporation tax. It's not applied in Ireland, and it was really only the Green Party which were suggesting that there should have been some sort of development levy on land. So the next issue we look at is corporate tax and financing, the decision between debt and equity. Where do companies get their monies from? So we'll take it up from that tomorrow.